In this video, I will reveal 6 effective strategies to help you boost your credit score with a low income that will open doors to future financial opportunities. Whether you're a student, a young professional, or anyone hustling on a tight budget, stick around because I will be revealing practical ways to boost your credit score. So, let's dive right in. Before you can build your credit, you need to know where you stand. Start by checking your credit report for free through online free sites available in your country like the annualcreditreport.com for people living in the US. Kindly leave a comment below on the available credit report site available in your country so that others from your country can also get to check theirs. This will give you a clear picture of any existing accounts, debts, or discrepancies that might be affecting your score. Think of your credit score as a grade for your financial responsibility. It's a number that lenders use to figure out if you're a trustworthy borrower. There are 2 main types of credit scores, FICO and Vantage Score. These scores are calculated based on info from your credit reports, like your payment history, how much you owe, how long you've had credit, and more. The scores usually range from 300 to 850. Imagine it like this: a high score, 700 and up, is like getting an A+ on a test. It shows you're excellent with your money. A lower score, below 600, is like a C or D, showing that there's room for improvement. The better your score, the easier it is to borrow money, rent an apartment, and even get better deals on things like car insurance. Now, you might wonder why all this credit stuff matters, especially when money is tight. Well, building credit on a low income matters because it's like a financial passport. With a good credit score, you can unlock doors to better opportunities. If your score is solid, lenders are more likely to say yes. Plus, a strong credit score can save you cash over time. Lenders offer lower interest rates to people with good credit, which means you pay less to borrow money. Understanding your starting point is crucial to making informed decisions as you move forward. Now that you understand where you are with your credit score, let's explore some practical ways to start building your credit score with a low income. 1. Getting a secured credit card. Think of a secured credit card as training wheels for credit. This card requires a small cash deposit up front, which becomes your credit limit. This deposit acts as a safety net for the card issuer. If you can't make payments, they can use your deposit to cover the debt. You give the bank a little cash up front, and they give you a credit card with a spending limit. It helps you build credit by making small purchases and paying them off on time. So, if you put down $200, you'll have a $200 limit. This helps you learn how to use credit without going overboard. Just remember, using it responsibly is key. Buy small stuff, like groceries, and pay it off in full every month. Over time, your responsible use of the card can boost your credit score and pave the way for unsecured cards with higher limits. 2. Become an authorized user. If you have a family member or close friend with a good credit history, consider asking them to add you as an authorized user on their credit card, as their positive credit history can reflect on your report to giving your credit score a little boost. However, be cautious and make sure the primary cardholder is responsible with their credit. You don't want their mistakes to affect your score. So, choose someone you trust and who's good with their credit. 3. Pay your bills on time, every time. Paying your bills on time is like hitting the credit score jackpot. Your payment history is a significant factor that lenders look at. If you consistently pay your bills on or before the due date, it shows that you're reliable and responsible. Late payments, on the other hand, can lower your score and make it tougher to get credit in the future. Set up reminders, use calendar apps, or even automatic payments to make sure you never miss a due date. If you would like to track your finances and know where your money is going, I have linked a monthly budget tracker in the description box below that you can get to track your finances. 4. Start small by embracing credit builder loans. Credit builder loans are like a superhero in the credit world. They help you build credit while saving money. They are designed for people who are starting from scratch or rebuilding their credit. These loans are usually offered by credit unions and community banks. The loans work by depositing a small amount of money into a locked savings account, which you cannot access until the loan is paid off. You borrow a small amount, let's say $500, and instead of giving you the money up front, the lender holds onto it. You then make monthly payments, with interest, over a set period, usually 6 to 12 months. And at the end of the loan term, you get your money back minus the interest. But the real magic happens in your credit report. Each on-time payment you make gets reported, showcasing your responsibility. So, by the time the loan is paid off, you've not only built credit, but you've also got a nice little savings pot waiting for you. 5. Manage your credit utilization ratio. Your credit utilization ratio is the ratio of your credit card balances to your credit limits. In simple terms, it's how much of your available credit you're using. If you have a credit card with a limit of $1,000 and you've used $500, your credit utilization is 50%. Why does this matter? Well, creditors like to see a low credit utilization ratio, generally under 30%. So, if possible, keep your balances well below your credit limits. For example, if your limit is $1,000, try to keep your balance around $300. This shows you're not overly reliant on credit. But, if you consistently max out your card, it could raise a red flag. So, even if your credit limit is low, aim to keep your balances as low as possible. 6. Monitor your credit report. Monitoring your credit report is a crucial step in building and maintaining a healthy credit score. Regularly checking your credit report allows you to ensure the accuracy of the information being reported by creditors and lenders. Mistakes on your credit report can potentially lower your score or even hinder your access to credit when you need it. By reviewing your credit report, you can quickly identify and address any discrepancies, such as incorrect account information, late payments that you believe were made on time, or accounts that you don't recognize, which could indicate identity theft or fraud. To monitor your credit report, take advantage of the free annual credit reports provided by the major credit bureaus, Experian, Equifax, and TransUnion. You can request one report from each bureau every year, spreading them out over the course of the year to maintain continuous oversight. Additionally, many online services offer free credit monitoring tools that provide regular updates on changes to your credit report. By staying vigilant and proactive in monitoring your credit report, you can ensure the accuracy of your credit history and take steps to improve your credit score over time. If you've reached this far, here are 2 great bonus ways to boost your credit score higher and faster. The first one is communicating with lenders and creditors. Remember, financial difficulties happen to the best of us. If you find yourself in a tough spot where you can't make a payment, don't just hide under the covers. Reach out to your lender or creditor and let them know what's going on. They might be able to work out a temporary arrangement, like a payment plan, to help you get through the rough patch. This proactive approach shows lenders that you're responsible and willing to find solutions, which can keep your credit score from taking a nosedive. The second one is diversifying your credit types. When it comes to credit scoring, demonstrating your ability to manage different types of credit responsibly can have a positive impact. Lenders want to see that you can handle various financial responsibilities, whether it's a credit card, an installment loan, or a retail account. Each type of credit serves as a different indicator of your financial discipline. By diversifying your credit types, you showcase your adaptability and financial stability. For instance, a credit card reflects your ability to manage revolving credit, while an installment loan indicates your commitment to repaying a fixed amount over time. Retail accounts can reflect your responsibility with smaller, focused lines of credit. However, while diversification is important, it's equally essential to manage the process wisely. Applying for multiple credit accounts within a short span can raise red flags for lenders. Each time you apply for new credit, a hard inquiry is generated on your credit report. These inquiries can slightly lower your credit score. So, if you're applying for multiple new accounts rapidly, it can negatively impact your overall creditworthiness. Instead, take a thoughtful approach. When considering new credit, make sure it aligns with your financial goals and that you can manage the obligations effectively. Spacing out applications allows you to maintain a steady credit history while minimizing the potential negative effects of hard inquiries. Building credit is a journey, and every step you take counts towards a brighter financial future. It might seem like a daunting task, especially on a low income, but by following these simple strategies, you're setting yourself up for success. It's about consistency, responsible choices, and a commitment to improving your financial well-being. So, start by turning those dreams into reality, one credit score point at a time. If you found these strategies helpful, don't forget to like, subscribe, and hit that notification bell for more empowering financial content.